JOLTS, Jerome Powell, the broken housing market. And yes, I'm even going to ask you, the audience, to help me understand the national housing market. But before we get into that, let's congratulate two people for getting their first deals, folks. This is the One Rental at a Time family. We do the work, we get deals, and I want to congratulate Colin and Paul for getting your first deals. Your golden tickets will be in the mail this afternoon. Folks, if you want to get one of these golden tickets, all you have to do is close your first deal and say that One Rental at a Time helped you some way, somehow. You do not have to be a subscriber. You do not have to be a student. You just have to watch the channel and say, hey, Michael, you helped me. And just so you know, we do have a card for you when you get your second, third, fourth, and so on. But yes, the golden ticket is for first deals. One more time, Paul and Colin, congratulations. Your card is going out in the mail. So let's talk about Jerome Powell. We touched on Jerome Powell ever so subtly yesterday. I've had a lot more time to digest what he's talking about. And let's not forget, he is talking again today. Today I will be looking for, does he walk back anything he says? I don't think so. But hey, we will see what he has to say today. But yesterday, I think Jerome Powell did his job. Jerome Powell yesterday was very close to Jackson Hole Jerome Powell. If you don't remember Jackson Hole, it was probably, I don't know, 6 or 9 months ago. We talked about it on this channel, where he had an 8-minute speech where he basically said the stock market, the bond market is wrong. The Fed needs to go higher. We need to be serious. And that started the 75 basis points moves. Yesterday was the second coming of Jackson Hole. Succinct, clear, and he is trying to scare the market. And it worked. He talked about 50 basis points. He talked about being data dependent. He talked about data coming in hot. He talked so tough that the chances of a 50 basis point move, depending on who you read, has risen to between 63 and 73%. I have seen both numbers reported. Regardless, before yesterday, the odds of a 50 basis point move on March 14th were less than 30%. They are now conservatively over 60, and on one report, over 70. Now, let's give Jerome Powell his flowers. I believe Jerome Powell will Bernanke us and give us a quarter, and then a quarter, and then a quarter. That said, as you will see in a minute, we got some ADP and some JOLT reports that make my Bernanke call less confident. But yes, folks, Jerome Powell did his job. Just like at Jackson Hole. He shook the market and said, you're not paying attention. We are going higher. We are going to stay there longer. And we might go faster. Jerome Powell gets an A+ for performance. I believe the action in the stock market down 500 points. The action in the 2-year above 5. The action in the 10-year above 4 is exactly what Jerome Powell was drinking champagne yesterday, in my opinion. And the key to all of this is Jerome Powell uses his words, his voice. He may not have to raise as much. It is just this quandary that you and I keep talking about every day, that the Fed has two things: the actual raise and then their voice and their words. So much so, BlackRock, the largest, I will say that again, the largest money manager on the planet, is now forecasting 6% Fed funds terminal rate. The more companies that forecast 6% terminal rate, the less chances he has to go that far. It is just one of these things. And now, why do I think we get Bernanke'd and we get a quarter and a quarter and possibly a third quarter? It's because what we've been talking about, inflation. I've been trying to highlight inflation for 9 months. There are 3 components. There is stuff or goods. We have already seen that roll off. then there is housing. Jerome Powell, in my opinion, wants to get to July or August and see how powerful the housing disinflation is. As I've said for almost a year now, housing is late, it's lagging, it is what it is. You could be Jeremy Siegel and scream all you want about housing going down now. That's not how the data works. How the data works is it's lagging, and we know with a fair amount of certainty that the data should get better in July and August. In fact, housing on Tuesday's CPI may still be going up. That's how delayed this data is. So again, I believe Jerome Powell doesn't want to break the economy. I believe he wants to go higher, but I believe he will go there at quarter points because he knows there is a lag effect, and he is confident, I think is the right word, because he doesn't know, but I think he's confident that housing will have disinflation come late summer. So that's why I think quarters are coming. But hey, the numbers that came out from ADP and JOLTS today and wages, we got 3 numbers today. All 3 numbers hot, hot, hot. ADP. Remember, ADP is private payrolls. On Friday is the big number, Bureaus of Labor and Statistics. That's the big number. But on Wednesday, we got ADP, private payrolls. Private payrolls were estimated, let me make sure I get the right number, were estimated to be 205. They came in at 242. Roughly speaking, that is a 20% beat. Jobs came in hot. And they're in the segments you would think, leisure, hospitality. Interestingly enough, manufacturing. I don't remember exactly, but I think manufacturing was up like 48,000 jobs. Jobs that are losing, construction. Kind of what we would think, right? So again, jobs came in hot. Wages, 7.2%. If you stay at your employer, at your job, the average wage increase year to year, 7.2%. Said another way, if you are not getting a 7% raise each year, you are behind the average worker. Now, if you are a job hopper or a job changer, the average increase is 14.3%. In the JOLTS report, it is called a job switcher. Quit one, move to another. So again, I ask you, at 4.5% FUDs rate, can it beat back wages at 7.2? The answer, of course, is no, we are going higher. And then finally, the JOLTS report, job openings. Remember, how many openings do we have to unemployed? Right now, the ratio is about 1.9. It did not get much better. Estimates for the JOLTS report were, let me make sure I get this right, 10.55 million. They came in at 10.82 million. That's about a 2%. So that's close enough, in my opinion, for government work. So again, about a little above, but close. It is down, however, from last month at 11.2. So it's down about 400 grand, roughly. But again, the job market is hot. Wages at 7%. Higher for longer is the answer here. Broken housing market. So this started with a tweet from Ryan Lundquist in Sacramento. If you don't follow him on Twitter and you're in housing, you need to. Let him know you came from one rental at a time. I'd love to interview him on my channel. Basically, what Ryan showed in Sacramento is below the median, he has 1 month of supply. Above the median, over 3 months of supply. So I took that data and I asked Omar, our Tuesday expert from the high desert in California. High desert is interesting in California because it is the cheapest MSA. It's about $400,000. So I asked Omar to pull up the MLS and give us 4 numbers. Below the median active, below the median pending, above the median active, above the median pending. And like Sacramento, they had more pendings than actives below the median, and they had a lot more. If I remember right, it was like 520 actives and 130 pendings. So again, the housing market is broken. What have we talked about? Luxury, dead. Move up, dead. Entry level, white hot. White hot. So while the high desert is interesting, I took that same question to Beth Traverso, who is a top 1% agent in the nation. Not her market, the nation. And she services basically Seattle. I asked her the same thing. And once again, we have more pendings than actives below the median, which in her market is 800 grand. I think it is King County, if memory serves. And she has more listings or actives than pendings above the median. So, homework for you. I want to hear from across the country. One rental at a time is a worldwide group, and I need your help. So please, if you can, I want to hear, A, what is your median home price for your market? I want to know how many active listings below the median, how many pendings below the median, right? I want to know that ratio. And then I want to know how many actives above the median and how many pendings above the median. Just those 4 numbers. So tell me the median, and if you can, give me those numbers. What I am seeing and becoming ever more confident in the call is the housing market is broken. There's this pent-up demand for first-time home buyers. Builders are not supplying. The would-be move-up buyer who usually sells is not selling. We are hearing more and more people like Fortune and Bloomberg and CNN and all these people say, you know what? I'm not selling. No kidding. We've talked about that for 9 months. And if the inventory doesn't come in, there's nothing there to buy. So even though affordability is near record lows, it's not quite 1981, which is the record, but it is bad. So demand is clearly off, but there's no supply. Like you hear from Lance Lambert, our Thursday expert and Fortune editor. You hear from Logan Matsushima at Housing Wire, who's been on the channel. Listings are down, actives are down, but days on market are up. That's because luxury and move-up homes are aging out. We have a market that is so bifurcated, it is not even funny, and nobody is talking about it. So lastly, if you are an investor or a flipper, as you've heard from several of my flippers, focus below the median. Go buy the junk, the stuff that doesn't qualify FHA, the stuff that needs a full facelift, gut remodels, below the median. Buy cheap, buy cheaper, and you can make a profit. Do not touch. In fact, yesterday with Omar, he told me about a deal he's getting done that's about 20% above the median. And I told him, Omar, I think that's a mistake. What are you doing? But I'm buying blah, 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 blah. No, I think that's a mistake. There is some stuff you don't touch. But we will see. So I actually had him give me the street name. We're going to follow up every couple of weeks and see if I'm right or if he's right. So again, please help me. I want to know your market, the median, and those 4 numbers. And then finally, mortgage volume. Shockingly enough, mortgage volume is up week on week. But let's not forget, last week was a 28-year low. So coming up from a 28-year low is nothing to celebrate about, but it is up. It is a fact. It is a data point. Let me make sure I get the right number. It is up 7.4%. And shockingly enough, refi demand was up 9%. Both of these numbers undoubtedly because the volume was so small, right? If you do 10 one week and you do 11 the next week, that is actually a 10% increase. So these increases are likely very distorted because the volume is so small. But again, up is up. Other things I've noted is it looks like used cars. We talked about used car market cracking. We've talked about repossessions, but it looks like used car volume, at least to the beginning of this year, is unseasonably strong, up 4.3%, the highest since 2009. Who would have guessed, right? Aren't we supposed to be struggling in cars being repoed? I thought that was interesting. What else do we got? CrowdStrike had earnings. They beat top, beat bottom, and gave strong guidance. Stitch Fix, we talked about them over the weekend. They missed top line, missed bottom line. They actually lost 58 cents a share when they had expectations of losing 34 cents a share. TikTok looks like it's on the cusp of being banned. I don't know if your kids or yourself are addicted to TikTok, but it looks like we have a bipartisan Senate bill that could be in the president's hands fairly shortly. And yes, TikTok, I don't know, maybe in a couple weeks, might be banned. I don't know if you're a fan or not. I would certainly like to see it go away, but I don't have a dog in the fight. It's not on my phone. We'll see. 10 years over 4%. This is crazy. The 2-year note is over 5, or at least it was this morning. Do you know what the 30-year note is? The 30-year Treasury bond, I guess, Treasury bond. The 30-year is at 3.9. You could borrow 30-year money at 3.9 or 5% for 2 years. What does that tell you? That tells you that Jerome Powell did his job. Jerome Powell is going to keep tightening, ratcheting up until something breaks. And what breaks might be the economy, at which point he will be forced to cut. That's all this is telling you. At the end of the day, Jerome Powell, in my opinion, his motives haven't changed. He wants to beat inflation. He wants to break the Fed put. He doesn't want a double dip recession. Again, when you go look at the 50-year spreadsheet, it is very clear that you don't want to give up on inflation too early. It is kind of like antibiotics. If you get a week or 2 weeks of antibiotics and you only take half of it, there's a chance, and some would argue a good chance, that that thing would come back, and it would come back stronger. That is what happened in the early 80s until Paul Volcker finally said, I've had enough, I'm going to break it, and we saw 20% funds rate. I believe Powell is a student of history, and he won't give up. He will wait another month or two. The economy could be in a recession. Unemployment could be over 5%, and he's going to go, we're going to wait one more month. We're going to wait one more month. That is my belief. So at the end of the day, folks, we are on the cusp of an important CPI reading. Actually, we got a jobs number on Friday, CPI reading on Tuesday. It is going to be interesting. I still believe we're going to get a quarter, but the Fed will undoubtedly talk tough. I look forward to seeing what Jerome Powell has to say today. Again, do me a favor, like, subscribe, comment, be a part of the One Rental at a Time family. And again, if you get a deal done, let me know whether it's your first deal or your next deal. I want to send you a card. I want to count it. Paul and Colin, congratulations. Folks, have a wonderful day. We're talking to the one and only Anna Kelly shortly, special guest at 9, and I believe Matt the Mortgage Guy at 10 o'clock. So a full day, all for you. Like, subscribe, comment. Bye-bye.